This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. Welcome back to the Investing with the Whales podcast. Super excited for my next guest. She was actually a speaker at my last investment conference. It is Ming Zhao. She is a former hedge fund investor, and she's now building her own fintech. So Ming, welcome. How are you?
Great. Thanks so much for having me on the show, Jonah.
Absolutely. And you're in San Francisco, right?
Correct.
Can you tell us anything about the new company / fintech that you're building? I know it's sort of stealth, so you probably can't say much, but anything that you can say?
Yeah, definitely. So we are building a company to democratize markets. It's for ultimately it'll affect retail investors. However, we're not working directly with retail investors. We'd be working with all your favorite brokers that you know and love, and of course, any brokerage that you have in mind, we're probably talking to. But essentially, what we're trying to do is make options which currently trade on multipliers of 100 down to make them tradable and available for fractions, so that you can, let's say, if you want to buy $100 of Tesla at the money calls instead of whatever they're going for right now, instead of paying thousands of dollars, we can allow you to just trade however you want depending on your wallet size. Okay. So that's currently pending approval. So we're not live yet. We're currently in stealth, but essentially we're trying to open up markets so that wallet size is no longer a barrier.
Cool. So let's talk about just your background real quick. I know you worked at some pretty prominent hedge funds. Which ones did you work at, and anything you can share with us about that experience?
Worked at Point72 as a long-short analyst and in the academy program. So a lot of, long-short fundamental investing was what we did. It was sector specific. It was kind of a pod shop. So every PM had his set of analysts looking at a specific sector, covering a specific set of stocks in the universe, doing fundamental investing. So looking at 10Ks, 10Qs, trying to predict earnings for the most part, unless, it depends on the sector actually. But so if you're in healthcare, you're probably looking at, bets around FDA. And so looking into the science a bit. If you're on energy, you're probably looking at like inventory counts and reports. And so it's not always earnings, but essentially looking at fundamental drivers of a stock. Okay, cool.
So before we started recording, I asked you what you want to talk about, because we try to keep this open format up to the speakers, whatever is, most interesting to them at this time. And you said you wanted to talk about the kind of the startup landscape and how it feeds into the public markets and what's going on with startups right now and fundraising and capital, and, how the Silicon Valley Bank failure is impacting fundraising and all of that stuff, hiring, firing. You're in San Francisco, so you see a lot of this stuff firsthand. So where would you like to dive in and start? Do you want to start with Silicon Valley Bank and, how the collapse of that is going to impact the startup landscape?
Yeah, sure. It sounds good. So I think from our perspective, Silicon Valley Bank is a name that obviously, being in Silicon Valley, we're quite familiar with. Being a startup entrepreneur, we're quite familiar with here. It's a name that, I guess, first of all, had such credibility and such a long track record, kind of almost like the too big to fail feeling, but nobody thought it would happen again. And it was a name that for my business, we were actually looking into a credit facility for the last several months. So we talked to venture debt firms, we talked to kind of a bunch of people in the Valley, and almost all of them.
Just real quick, just so if people aren't familiar with the term venture debt, can you just explain what that is?
Yeah. So startups need to fund their growth. They can fund over equity or debt. Equity would be your traditional venture capital raise. They take a stake in your company. They don't really expect you to, pay back the amount of capital immediately or after, 1 year, 2 years, et cetera. Venture debt earns interest on the capital. You're supposed to pay back the principal after whatever your your maturity date is. Usually for startups, it'd be like a year or 2 years, or you pay back some principal every year. And so typically, but they also have warrants. So it'd be like, we kind of take equity in your company, or we have a chance to take equity in your company. And we want our 15% our IRR, internal rate of return. So that's kind of like the venture debt business. We
Silicon Valley Bank did a lot of that too, right?
Yes, they did. Yeah, so we were looking at basically we had a need for to raise credit facility at some point. And so everyone directed us to SVB. They were like, talk to SVB. You want, you don't want a term loan. You want like, you want a revolving facility. Like, we don't do that. Like, you should talk to SVB. And it was kind of like the feeling that almost like everyone in Silicon Valley, if you were an entrepreneur, you had a credit need, you go to SVB.
Yeah, because your traditional community bank isn't going to do much banking. They're not going to offer credit to a startup that doesn't have any sort of a track record. They want 3 years of financials. And it's like, I don't have financials. This is a startup.
Yeah. And then I also heard from friends that, sometimes they'd be like, okay, we want to raise, a line of credit. And but then in order for that to happen, SVB would say, well, you need to bank with us. So they also kind of got a bunch of, banking customers that way. And then, so basically they have this kind of like monopoly over Silicon Valley and especially, growth stage startups. And I guess fundamentally what led to their collapse was a mismatch in duration. So their assets and their liabilities effectively had, a mismatch. So the amount of, people expecting to take money out had a difference in risk and expected time of taking out money versus basically money coming in. So cash flows coming in. So effectively depositors at a bank are actually, that goes into liabilities, because when you deposit money into the bank uses it to lend, but then you can ask for that money back at any point in time. So that clocks in as a liability on the bank's balance sheet. Whereas their assets are actually the loans that they make to startups for the most part, for SVB.
Or mortgages. I mean, they didn't do a lot of mortgages.
Or they can,
invest
in mortgages. Yeah. And so they were heavily invested in like longer dated treasuries, in mortgage products, and the durations were, let's call it an average, I forgot exactly, but let's call it like 5 or 6 years out, average duration. Whereas the liabilities were very much like, you can just withdraw your deposit at any point in time.
And as we saw, Peter Thiel and a couple other people send out some tweets, and all of a sudden you get, tens of billions of dollars of withdrawals within hours, because it's so easy now to move money around between banks, a couple clicks of a button, and, you've moved all your assets.
Yeah, exactly. So in a sense, like we almost like, no one was paying attention to how Silicon Valley Bank was managing their risks. And no one was tracking, no one really knew. And then all of a sudden the news comes out like, hey, like you should withdraw your funds. And like VCs were telling startup founders like, hey, you should do this now. Like it was like Wednesday, people were like, you got to do this immediately. And then Thursday, and it's like, all right, if you haven't done it, like you're fucked. Like you just need to.
It was a legit run on the bank. I mean, it absolutely was a run on the bank.
And then at a certain point, it was just like your friends were doing it. So if you weren't doing it, like, will you end up as a bag holder? It was almost like, let's not worry about the fundamentals here. Let's not care about whether,
your friend is your relationship manager at Silicon Valley Bank and is going to lose their bonus because you pull your assets. Like if you're trying to run a company and all of a sudden your $5 million gets frozen, like you're fucked.
Yeah. So I think everyone was just like, well, it was kind of a self-fulfilling prophecy. It was like, if other people are withdrawing, then maybe like if everyone did not withdraw, maybe there's no problem.
Oh yeah, for sure.
When people withdraw, like then you have to withdraw yourself. And so it's just a matter of getting ahead of the curve
It's like the same thing where, the stores probably said, or, the health experts during the pandemic said, don't buy more, toilet paper than you need, don't buy more wipes than you need. But you're like, no, screw that, because everyone else is buying more than they need. So like, if I don't buy more than I need, there's not gonna be anything left for me. So
exactly.
nobody wants to be last.
Yeah, so I guess that happened. That was, very much, it was just like a blip in, in the last month, or, in the time expanse of, typical, founder's journey as they're building their company. But
And I can't imagine, like, imagine someone just raised a B round. They had 10, $15 million sitting in the bank. And all of a sudden they find out that Silicon Valley Bank might fail and their assets might be at jeopardy. Like, the panic that must have been going through Silicon Valley is like, I'm sure it must have been epic.
Yep. Yeah, and then I guess over the weekend, or I guess that Friday, there was the announcement that the FDIC was gonna shut it down, take it over. And then everyone was like, well, that was fast, like that was unexpected. And at that time, it was kind of like a lot of analysts were still like, wait a second, maybe they're actually like healthy after all. Like, sure, there's like, some mismatch, but worst case, or like if you just like hold, or if they were able to somehow like keep their
Like
deposit,
borrow money from the Fed or something to plug the hole.
yeah, exactly, borrow money, or like I mean, they weren't like technically, they were holding safe treasuries, so like if you just waited out 5 years, like the price is going to come back up. Or
well, and you saw what all the banks did for First Republic. JP Morgan and all the other banks decided to get together and basically give First Republic like 30 billion of bank deposits, just so that they could, plug the hole on their balance sheet and not have to sell off some of those long duration assets and take the loss. Like, it's too bad they didn't do that a week earlier for Silicon Valley Bank.
Right. And I think Matt Levine also had a post out about how actually, like, minute by minute what was happening, and because things were shut down at like 5 p.m. and then you literally couldn't borrow until 8 a.m. the next morning. And maybe if things opened up, were open overnight and you can borrow overnight, then this wouldn't have happened. But
It is too bad. I mean, Silicon Valley Bank has a 40, 50, 60-year history. I actually know a lot of people that work there. I actually still have one of my businesses. I still do my banking there. I have a credit facility there. I have my business banking credit cards through Silicon Valley Bank still. So like, I didn't feel the pain. Like, my stuff technically got frozen for a couple of days, but it's all good now. But there are companies, large startups that must have been crapping in their pants about what was happening at the time. So now let's talk about what's the contagion from Silicon Valley Bank going down. What are these startups doing that we're relying on them for, credit facilities, venture debt? Is there anyone that's going to step up and take the place of Silicon Valley Bank?
Yeah, that's really difficult to say right now. So I think it's just it just eliminates like an entire like solution set for a lot of companies. And needless to say, there's whoever the closest alternatives are obviously getting a lot more business now, like more than ever. Like I think like a friend at one of the other banks that is popular in the Bay Area just said like they got 5 years of business. Wow. In a week. Like in a couple of days, 5 years of business. So definitely like there are alternatives, like there are venture debt alternatives, there are
and it probably means if you can't raise venture debt, you just have to raise more, you have to raise more traditional capital and give up more equity.
Yeah, I guess that's I'm sure some folks are thinking that way.
So maybe the VCs don't mind so much.
Yeah, yes, maybe that's good for the VCs.
Right.
kind of, not great for dilution purposes
Oh, for sure. So let's talk about valuations, right? I mean, I think that's where this all started. In the public markets, we've seen the S&P, it's down from its all-time high, but not by that much. The Nasdaq has rebounded nicely from those lows of last year. I mean, some of these big mega cap tech stocks, I think Apple's up 25% year to date. Amazon is up 20% year to date. Nvidia and Meta are both up like 80% year to date. So big tech has bounced back nicely. A lot of the big cloud stocks, Snowflake, Cloudflare, Datadog, those types, Twilio, Shopify, Zoom, like those stocks are still down 60, 70, 80% from their all-time highs. What does it look like with startups? Like these companies that were beloved, the unicorn club, they all raise hundreds of millions of dollars and we're hoping to go public at these lofty valuations. Like what's going on with them? I mean, are we going to see any IPOs from startups in the next year?
Yeah, definitely there's trouble brewing, I would say. So it's kind of like a U shape where let's start with, tiny startups like seed stage, Series A, or maybe, up to Series A, I would say, on one end, and public markets on the other end. I think for the most part, super early stage and public markets are relatively not that affected. Like if you look at the S&P 500 index, it's roughly like mid 2021, like Q3 2021 levels right now, which is pretty good. Like what are rates now and what were rates in Q3 2021? Like a big difference. And yet the S&P 500 index is roughly, the same as it was before. And I would say on a similar note, early stage also, I don't think has really been impacted that much in terms of like seed stage valuations. But
those are valuations that are probably typically under 10 million, right?
Somewhere like, depending on if you're talking about AI, who knows? It might be all the way up to,
right. If you have AI in your name or your domain is like something.ai, right? You're raising at like 50 million right now, especially if you went through Y Combinator.
Yeah, I think like Stability raised at like $1 billion or something valuation, whatever.
Oh my God. That was their seed round?
It was like, like their first round. That's obviously an anomaly. But right. Say, maybe like first check, like, 10 mil cap plus.
Well, I mean, open AI. I mean, I know Sam Altman's been working on it for a few years, but I mean, that's still a pretty young company. And they just raised money from Microsoft at a $30 billion valuation. So like there's a lot of hype in AI, no doubt.
Yep. So I would say, valuations in early stage, probably, not really affected. Once you get to Series C, D, kind of that pre-IPO kind of like segment of the market, if you are an investor, like private market investor or VC in that segment of the market, for each company, basically look at when did they last raise, or if you're an employee, potentially considering joining one of those companies, look at when did they last raise and like how much run rate do they have, because chances are they're not going to be able to raise at the same valuation that they did in 2021, 2020, et cetera. And so if they're just like flush with cash, then maybe they can wait it out, like wait until, markets rebound in like 2024. But if they're running out of cash, there's a couple of things that those firms can do.
If they're running out of cash, they have to raise on a down round because the IPO windows are basically closed, right?
Yeah, so they can do a couple of things. One, they can raise more equity on a down round or flat round, whatever. Two, they could, instead of, and this is kind of where the debt question comes back into play. One thing that companies used to do is raise a bridge debt round when they don't want to raise a flat or a down round equity wise. And now that's gotten harder,
right.
With collapse of SVB. But I guess that's always still an option if you can manage to do it. The terms are probably a lot less attractive just because supply and demand has been shaken at this point. And I think this is already happening, but I think it will continue to keep happening at an accelerated pace in order to kind of push out that fundraising timeline. A lot of these like Series C, D, E, et cetera, companies are just gonna slash hiring, fire, have more massive layoffs just to extend that runway.
Has it been happening? I mean, we obviously hear about the public company layoffs across the tech sector, anywhere from 5% to 20%, sometimes more. Is the same thing happening with startups, mid-stage or late-stage startups?
It is definitely happening. I guess the big ones will be in the news, will be in like TechCrunch, smaller, startups. I mean, colloquially, I hear a lot of it. But I think there's definitely, hiring markets have changed, and it's really hard. It's not like 2021 anymore. Even if you're, a really great engineer, could be, pretty hard to find a role, or find a new role at this point in time.
So back in like 20 and 2021, I mean, I felt like, between Crunchbase and a few other newsletters that I get, it was like every day there was another company raising $100 million or bigger round. And now you don't see those announcements quite as often. Are the VCs that were doing those big rounds still doing big investments in new companies, or are they mostly just saving their cash for their existing portfolio companies to make sure that they don't run out of money?
Yeah. Well, I think definitely everyone is a bit tighter with their cash. I do think there's still a lot of dry powder, meaning a lot of funds raised new funds in 2021, 2022, et cetera. And so there is some pressure to deploy those funds. So they still need to make investments. They could be making their investments slower, being more selective than they were previously. I would say one thing that might be counterintuitive is now that I think let's take the extreme example, like 2021, let's say crypto. Literally like everyone and their mother is building a crypto company, and it's really difficult to distinguish between, or I don't know, sometimes it's difficult to distinguish between, some company that's really going to make it versus, your average company. But essentially every investor, has something to invest in. So they can essentially, if you were to plot everything as, nodes in a graph, like everyone has their pie. So there's a lot of connections. And then in 2023, I suspect what's happening is all of the investors are, if there's like a good company, like all of the investors are trying to pile into, the small subset. They're all just kind of maybe agreeing with each other more, and there's less of a it's very non-contrarian, perhaps.
So maybe there's still a lot of money just chasing fewer good ideas, fewer good companies.
Everyone is doing more due diligence, and everyone is more risk averse. So instead of being like, yeah, I'll take my chances on,
right, the spray and pray, the spray and pray, right? Like you make 15 investments, you assume 10 of them are going to zero, and you hope there's a couple home runs in there. Maybe they don't do that anymore.
Yeah, and I think like in a more risk averse environment, people are even more so. I mean, I feel like VCs get accused of just piling into the same deals in general because they all are non-contrarian, but I think that's definitely way more pronounced in a bear market where people are like, well, I don't want to get blamed for making the wrong decision. And even if it is the wrong decision, I can't be blamed if, all these other funds are also
right. If Kleiner Perkin also invested, and Andreessen Horowitz led the round, like if you're in that round and the company goes to zero, like, right, you're not going to take as much blame as if you're the lead investor and you do the whole thing yourself and it goes to zero. Then you look like a clown. I mean, we talked earlier about Stripe. Stripe just raised raised another round. I think part of the money that they raised was to pay the taxes on their employees exercising options, something like that. And that's just because they've been private so long, and those employees have to start exercising their options, and then they have to pay the taxes on it. Is that what's going on?
I'm not entirely sure if they specified exactly what they're going to use their cash for. I know they're trying to push back, or they've always been trying to push back IPO. But since recently they went from like a 90 billion valuation plus during 2021 to now, I think their last round was at like 60 or something, a lot less than the 90 billion. I think I don't know, because I guess we don't have information on how profitable they are, if they're profitable, etc. How much
I wonder if they regret not going public a year ago or a year and a half ago.
Yeah.
When everything was so frothy, they could have gotten a 90 to $100 billion valuation. I mean, look at Coinbase, right? Coinbase went public at, I don't know, 70, 80 billion, popped up to like 100 billion, and then it dropped 90% from there. So like, I don't know if that's good or bad. Like, I mean, everyone gets,
you raised cash at a really good valuation.
right. You're raising 10 billion, in that scenario, they probably raised, 8 to 10 billion of cash in the IPO. A lot of insiders got to cash out at those highs. And then the stock drops 90%, which, yeah, I mean, it hurts everyone that's still holding stock, but that's more the public shareholders that probably get, burned the worst on that. So Stripe's valuation, let's say that's down 30, 40%. I think Klarna just raised capital at a massive down round valuation. I mean, what do you think, like, the average company that's out there raising a C or D round right now, are most of them doing flat rounds compared to when they raised last, maybe 2 years ago?
Yeah, I think, well, the thing I hear the most is like, we're not raising. So just trying to drag out, that timeline as much as possible. But definitely hearing of, down rounds, flat rounds.
Are you seeing any M&A?
I think I actually really am only in tune mostly with fintech.
Okay.
I hear a lot of talk about, a lot of folks think that a lot of M&A will be on the horizon. I think I haven't looked at whether it's happening at a much quicker pace now than before, but definitely I think, let's just take the brokerage space. Neo brokers that have popped up, a lot of them popped up in 2020, 2021. I do think I agree with the general industry sentiment here that a lot of them are going to probably get acquired.
Disappear.
Yeah, because, well, the thing is, there's accounts. So let's say you're a broker with like 100,000 accounts. Like, those accounts are worth something,
Oh, yeah.
and a lot of brokers would pay for those accounts. And so at the very least, even if you're just gonna, move the accounts over and then shut down the broker, it makes sense to buy those accounts cheap. Because I think customer acquisition costs in fintech is still really high. It's definitely even if you're paying like $20 for each account and multiply it by the number of accounts of said small broker that you're acquiring, it probably makes way more sense than if you were to acquire
It might cost you $40 to go acquire that customer from scratch.
Yeah, exactly.
Yes, I think you will see some of that. I mean, some of those founders, they probably don't want to sell because they don't want to sell for the price that's being offered to them, because they look back 2 years and say, oh my God, my company was valued at 20, 30, $40 million in our last, at our last round. And now, now this company wants to buy us for $10 million.
Yeah.
But that's better, I guess, than getting nothing.
Yeah, there might be that agency problem where depending on their last fundraise, where if you get to like Series A, Series B, oftentimes you'll have a liquidation preference from the investor. So let's say the investor says, I have like 2x liquidation preference. It's probably on the high side, although given markets today, maybe not. But essentially what it's saying is that even if, you're the founder, you started the company, even if you own easy numbers, let's say 50% of the company at a certain point in time, and you are thinking of, selling the company, even if your acquirer says, I'm going to set this valuation, and let's say, and you calculate it, you say, okay, 50% of 100 million, let's say. So I get owed 50 million. That's like definitely not the case.
No, because your investors get all their money first.
Exactly. And so you might end up in a situation where after you factor in the liquidation preference of the investor, actually the owners, builders of the company actually are not going to get paid out anything. And so then they are highly not incentivized.
Right. Right. Like there's no point in selling at that point.
They're like, why would I go through this process?
Right.
Which is really inefficient for the market because you have all these accounts, they have to shut down now because nobody, wanted to put in the effort of actually going through with the acquisition because the players in the acquisition story here weren't properly incentivized. And then it just becomes a waste. So I hope that's not going to be the common thread here. I hope that, the market is going to be more efficient than that.
I mean, there were so many fintechs that came public through SPACs in 20 or 2021 that really didn't have any business being a public company yet. I mean, they had some revenues, but like they're still years away from being profitable. Margins are horrible. They're spending a ton of money to acquire new customers. And unfortunately, a lot of those SPACs are down 90 to 95% from, where they came public via SPAC. But like you said, I mean, there's still some value. I mean, they still do have some customers, they generate some revenue. So I do wonder at what point you see some of the public fintechs, start to acquire these sort of zombie companies, whether they're former SPACs or whether they're just in the private market with no other exit strategy. What else can you talk to us about in terms of startups, or what are you seeing in San Francisco? Obviously it's a tech heavy city. There's been a lot of layoffs at the big tech companies. Startups are obviously feeling the pain. Do you notice it around San Francisco? Like are office buildings a little bit more empty than they were before?
Yeah, definitely. So that's something else. I guess we could talk about real estate markets. So definitely in, I guess, first of all, there's a divide between residential real estate and commercial real estate. If we double click into commercial real estate and split off into, let's say, like multifamily homes, offices, we can basically, let's forget about like multifamily homes for a second, just focus on like office space. Definitely, I think there's even comparing like New York versus San Francisco. I guess I don't have like stats on this, but colloquially, all of my friends say, if you work in New York and you're in tech, like everyone's going into the office. I guess that's just the cultural norm.
Companies are probably forcing their people to come in because they're paying so much money for rent.
Yeah. And then if you work in tech in SF, the office is like generally very empty. And so you kind of have these like ghost buildings that are, 20% filled. Wow. And 80% vacant. And
at least the traffic situation must not be as bad, right?
Yeah, I guess that's true. Although, well, I actually don't have a sense of comparison like before COVID, after COVID on traffic, but
so I mean, what is going to happen to these buildings, right? If you're the owner of the building and you have it leased out pre-COVID, 90, 95%, I don't know how long the typical lease is. Let's just say it's 5 years, so you fast forward 5 years and now all these tenants are looking to, renew their lease, but for way less space or terminate their lease and they're going to move to a smaller building, a cheaper building, you know, that sort of thing. Like, what the hell happens to the people that owns these buildings? Like this, I just don't know how that ends well for some of them.
It doesn't, right? Because normally when you have a commercial real estate property, you have essentially tenant risk. So, and I guess that's directly related to occupancy risk. So the tenants are obviously paying rent. If you're not getting paid rent, how do you pay down your own interest that you have from, purchasing the property or getting mortgaged to purchase the property? And so then when interest payments can't get paid, then obviously there's default. And then on top of that, a lot of these, owners of the property or property management companies have engaged into essentially like there's fixed rate mortgage and there's also floating rate, and most of these commercial real estate properties are floating rate. And so back in 2021, it was fine if occupancy rates are down because, well, you're paying like less than 1% for interest. But now, interest
Everything's
rates
going to reset higher.
yeah, 4%. So now for a lot of these property management companies, the interest rate is now 8 times what they were paying last year. And on top of that, if your occupancy rate hasn't risen, then like how are you expected to dish out 8x what you're used to? And so then
and even worse, in most cases, it's probably down, right? I mean, there's more vacancy in these buildings now than there probably was a year or two ago.
Yeah, I think it's or at the very least flat. It's like not really been picking back up. And so I think there's going to be more defaults. There's probably going to be foreclosures or a lot more, this asset is not worth holding, so we're just going to sell it, or we're going to move to a different region. Maybe things are, doing a lot better in like Austin than SF, who knows? I mean, I guess they are. So there'll probably be a shift in, office, in the office space business.
I mean, not to mention like the whole work from home phenomenon sort of changed, where these companies can find talent now. If people don't need to be in the office every day, then you don't need to hire your engineers, all within a 30-minute drive of San Francisco. You can go hire your engineers, wherever they are around the world and just let them, work from home, which gives that company the ability to, downsize office space and move their headquarters wherever they want, I guess, too. Tesla, right? I mean, Tesla moved their headquarters down to Austin, for a lot of different reasons. But are you seeing any other large companies in San Francisco move their headquarters out of the city?
Yes, but partly probably for tax reasons.
I know. Taxes are out of control in California.
They are, yes.
Gas prices.
Yeah, especially if you're a fintech company, because I guess it has to do with revenue recognition. So if you're a SaaS company, you don't really have, I guess, what's traditionally called GMV. So like if you are, a middleman in a fintech stack and you're like, okay, my customers are going to pay me, let's call it like 100% of, whatever they pay me. And then I count those as gross receipts. And then I take my chunk as a financial service provider, and I hand off 90% of this revenue pot that I got from my customers down to the next business.
Right. You have your take rate.
Right. What is considered revenue? Is it your 10% take rate that is your revenue, or is it your 100% that you got from your customers? And this doesn't really happen in SaaS, or like broadly speaking SaaS. And the tax regimes are based on the top line, the kind of the GMV, I guess, the receipts. And so this makes it a lot worse. Or financial companies have to pay a lot higher tax because they're getting taxed on the 100%, not on the 10%. And so I guess a lot of them, or I guess savvy fintech companies that are like, hey, we're growing, so we're going to move offices from out of SF just to maybe 30-minute drive in
Well, so
South Bay.
that was going to be my next question. I mean, you're in San Francisco now. You're working on building your startup fintech. Why are you doing it in San Francisco? Have you thought about doing it in a different city or a different state that has a more favorable tax code, i.e., Texas or Florida?
I've definitely thought about it. It's kind of a further away consideration than, the tomorrow problems and the fires that we have to extinguish, but definitely something on the back of my mind.
I mean, do you think San Francisco and Silicon Valley will ever be the same? I mean, with Silicon Valley Bank, I mean, what's going on, the startups right now, I mean, markets bounce back, startups bounce back, but the loss of Silicon Valley Bank, I don't know if anyone will ever fill that hole the same way. Can Silicon Valley return to where it was a couple of years ago? Or are you going to start, are you going to see more exodus from San Francisco and Silicon Valley, more startups leaving, more talent leaving? And, what was so great about Silicon Valley is now going to be sort of spread out around the country.
I actually think the opposite. I actually do think that this will remain the hub for a long, long time. If you consider the kind of, what is the next hot thing, or like what is the current hot thing? Where is the industry going in general? Or where's the frontier of technological innovation? A lot of that is, let's just say, like now, like large language models, generative AI, all of that is happening in SF. Probably because the institutions, obviously Stanford is right, 30 minutes away. A lot of AI research coming out of Stanford, Berkeley, across the bridge. A lot of, these AI institutions are based here. I guess there's like, London, also kind of a hub, but for the most part, San Francisco is like the hub still for a lot of artificial intelligence research. So I think that there is a lot of there are a lot of reasons that keep people here.
Not to mention all the large tech companies, mega cap tech companies are all based there. So
Right.
So that talent that's there, they leave and they raise capital to start their next thing. And I mean, all those companies have huge AI groups. So you're going to see those people leave and want to do their own thing. Let's talk about,
they leave, they tend to just, stay here because sourcing talent is here, and
right, all their friends, their network. So we talked about this before we started recording, kind of the pre-show about AI and how there's so few publicly traded companies that are really doing anything meaningful in AI, where if you want to invest in AI, you're sort of limited to Google, Microsoft, NVIDIA, because they power it with their chips. And like, there's a few other companies that are doing AI or embedding ChatGPT into their services, like Salesforce or ZoomInfo. But like, can you talk to us about what's going on in Silicon Valley with AI startups? I mean, how many of these startups right now are doing AI, ML, which is machine learning, LLM, large language groups, or what is it? LLM is large. What is it?
Large language models.
Okay. There's so many freaking acronyms. I can't keep them all straight. There must be a lot of AI startups right now, right?
Are. Yep.
Like, is that where all the money's flowing from VCs?
That's what it feels like, honestly. Yeah, there's a lot of I guess you could broadly classify the innovation in two directions. One is image, video, kind of like generative AI images, videos, etc. And then the other category is large language models. So with large language models, obviously ChatGPT, like AutoGPT, the plugins, kind of like everything along that line. And then with the generative stuff, like I guess like copywriting, or like, whatever's the marketing equivalent of producing, videos, short form videos for companies for their marketing departments, etc. Or a lot of it is actually very consumer based. So generating like Lensa AI took off for a while, or people can make themselves look like cartoons,
Oh
etc.
yeah, yeah.
Yeah, themselves and their friends.
Have you
So
played around with Chat GPT at all?
I have, yeah.
What is it like? I haven't used it yet. I haven't tried it yet. Obviously, I've seen a million Twitter posts about it, but what are your thoughts, and what did you use it for?
Right. Yeah, I think it's definitely very impressive. But the question is always, the how many nines problem, or like how accurate do you need to be? How good do you need it to be, for 90% of corporate America to pay for it? And I think that, it's what would make it very, very useful, or a lot more useful than it is today, would be so some of the plugins like the code interpreter, which means you can essentially put in, you can put in code and it can run and it can generate an output directly in the ChatGPT terminal. And then there's also browsing, which means it can, have access to the internet. But right now, these are two separate modules. So you can't be like, okay, I'm going to pull down this thing from the internet, put it into an Excel file. Let's just say I want to I want to create an automatic process to pull down annual reports or quarterly reports when they come out. And so it'll be, some tracker that will track, these 5 companies and on their investor relations page. And so it'll pull down these reports, put them into CSV, and then run pandas operations directly on the CSV, or add up, be able to like add up, do arithmetic on, this like new data set that I have. Right now, it's these plugins aren't really available, not to, mass available, but B, it's or at least, I haven't, there's not a readily out of the box available solution that kind of like strings together these multiple different plugins together. So that would be super useful. I do think that obviously the robots.txt thing is really annoying. So if websites have that, then they, don't have access to that information, etc. Okay, that's fine.
Do you think Chat GPT is going to be a threat to Google?
Absolutely. I kind of joked about this, but I think that the way that we have like SEO right now, where all the companies are like paying to be at the top of the page for Google PageRank, at some point companies are going to be paying to be the first one to come up when, when an average user is, typing in like, hey, what are the top brokers, that offer options into ChatGPT. Like I bet you companies will be paying soon to be like the number one that comes up. How exactly they'll be able to kind of like get into the front of the queue by paying, by like what will it actually look like in the model?
Right.
Because supposedly these results are, randomly generated output. I don't exactly know. Maybe there'll be some like level of like weights at the end, where they can just like upward weight the companies that have paid depending on how much they have paid. Who knows? Or maybe
because with Google search, you have SEO, which is where you're showing up organically based on the the content and the credibility of your website, your blog, whatever. And then you have, I guess it's PPC, paid per click, or whatever, at Google AdSense. I don't even know. I mean, I don't do any Google advertising, so I forget exactly what it is. But right, that's where people can pay to have like their sponsored link, their website at the very top of the search before all the organic results. And so if you type in like best sushi restaurant in Boston, at the top of the page you'll see like the 2 paid links, and then you'll see the organic links underneath that. And you might, every time someone clicks on your paid link, whoever owns that website might be paying Google $1.50, $2, $5, whatever it is. So I mean, that is a massive business for Google, like probably $150 billion a year business for Google. And that's what's at risk.
Yep, exactly. So I definitely think Google has a lot to worry about. And actually, I think just like, personally or empirically, I mean, I was like a super big like bear on ChatGPT when it first came out. I was like, oh, there's no way I'm gonna, use this to like search instead of Google. But honestly, I think it's probably like 50-50 for me at this point in time. So
Are you old enough to remember Ask Jeeves?
I do, yeah.
This is like Ask Jeeves, 3.0. I mean, I don't know if anyone remembers, like back, 15 years ago, there was so many of these search sites. I mean, it wasn't just Google, Yahoo, Bing, you had Ask Jeeves, you had, I don't know, there was a whole bunch of other ones too. And they've like slowly just disappeared over time. But,
Right.
and then Google just owned the entire market. I mean, Google probably has 90% of the search market right now, maybe even more than that. But it looks like they finally have some real competition from ChatGPT.
Yeah, definitely. And it's ChatGPT can get browsing to work where they can, browse multiple sites instead of sequentially, which is, the current setup, which I have faith that they'll figure it out. If not, I will try to put pressure on them.
Well, I mean, the other question is, it's also way more expensive for ChatGPT to do these searches, right? It takes so much more power. Like I've heard it's costing OpenAI or Microsoft like 10 times more per search than what Google is paying per search. I mean, you're talking like fractions of pennies here, but obviously it all adds up. So, I mean, at some point that becomes part of the problem, right? Like if it costs 10 times more for ChatGPT to do a search, how do they make money off it?
Well, I think the answer is if they have a truly better product, then there are a lot of willing players that are going to just dump as much money as it takes to secure the monopoly. And then they can, charge as much as they want from there and make it all back. I think that's, probably the sentiment there.
Okay. Anything else we didn't get a chance to talk about that you wanted a chance to discuss? I know we covered a lot of ground. Well, thank you so much, Ming. Really appreciate your time. I mean, I know you're West Coast, so it's only like 6:30 out there. It's almost my bedtime here. So
thanks so much for taking the time back.
Oh, no worries. No worries. This was a fun conversation. So wish you the best and definitely keep me posted on the launch of your new company.
Sounds good.
Okay. Talk to you soon. Bye.